You have a little extra money at the end of the month, but the moment you try to figure out what to do, you are hit with a wall of acronyms, tax rules, and competing advice. The financial industry builds its business model on making this process feel incredibly complicated. So you do what most people do. You do nothing. You leave that extra money sitting in a checking account. But because of inflation, cash loses its purchasing power every single year. Standing still actually means moving backward. The counterweight to that erosion is compound growth. When you invest, your money generates a return, and then those returns generate their own returns. Time becomes the most important variable in your financial life. This chart compares two investment timelines over 35 years. One person starts investing at 25, the other waits until 35. That 10-year delay creates a gap of hundreds of thousands of dollars by retirement, even if the late starter saves more to catch up. We are going to cut through the noise. By the end of this video, you will have a definitive, step-by-step order of operations for where to put every next dollar you earn. Building wealth rarely comes down to picking the perfect stock. It comes down to sequencing your decisions, putting the right money into the right accounts in the exact right order. Before you open a brokerage account or buy a single share of an index fund, you have to pass the pre-investing filter. Think of this as the mandatory baseline to protect you from market volatility. This checklist outlines your first two mandatory steps. Step 1 is holding 3 months of living expenses in cash. Yes, that cash will slowly lose value to inflation. That is the cost of liquidity. If your car breaks down or you lose your job, this cash buffer ensures you don't have to sell your investments at a loss to survive a crisis. Step 2 is clearing out all high-interest consumer debt, especially credit cards. Earning a 10% return in the market means nothing if you are paying 20% interest to a credit card company. Once you check those two boxes, you shift from a defensive financial posture to an offensive one. You have the stability to accept market risk. Now you need a place to put your money. Think of accounts like 401(k)s and IRAs as shopping carts. The cart itself doesn't make you money. It's just the tax-advantaged container that holds your investments. If your employer offers a 401(k) match, that is your first target. When an employer matches your contribution, they are giving you a guaranteed 50 to 100% return on your investment the moment the money clears. This matrix breaks down the primary trade-off for retirement accounts, deciding when you want to pay the IRS. You have two choices, traditional or Roth. A traditional account lowers your tax bill this year. You put the money in tax-free, but you agree to pay ordinary income taxes on every dollar you withdraw in retirement. A Roth account uses after-tax dollars. There is no immediate tax break, but your investments grow completely tax-free, and you won't owe the IRS a single cent when you pull the money out decades from now. Then there's the standard taxable brokerage account. It has no contribution limits, no age restrictions, and you can withdraw your money penalty-free at any time. But that flexibility comes at a steep cost. A brokerage account offers zero tax shelter. You will owe taxes every year on dividends, and you will pay capital gains taxes whenever you sell an asset for a profit. The central tension in personal finance is liquidity versus tax efficiency. If you want compounding tax advantages, you have to trade away immediate access to your cash. Once you choose your shopping cart, you actually have to put something in it. For long-term wealth, the optimal engine is a low-cost S&P 500 index fund. It provides broad diversification across the largest U.S. companies, which is exactly why Warren Buffett advises the average investor to use them. This chart maps different asset classes against your time horizon. Index funds sit directly in the 10-plus years category. They passively track the market, historically average around a 10% return, and charge practically zero management fees. The trade-off is entirely psychological. To capture that 10% average, you have to be willing to endure years where your portfolio drops by 25% without panic selling. Conversely, if you need the money in less than 5 years, say for a house down payment, you stay in the top row. You hold cash or short-term bonds to protect your principal, consciously sacrificing growth for safety. Your choice of asset is entirely dictated by when you need to spend the money. Your timeline defines your risk tolerance. Here is the complete decision tree flowchart. This ties the prerequisites, the accounts, and the assets into a strict order of operations for your next dollar. If you are just starting out, do not skip ahead. Secure your emergency fund, capture your employer's free 401(k) match, and wipe out your high-interest debt before you even think about opening an IRA or a brokerage account. Once the foundation is set, you map specific accounts to specific life goals. You max out an IRA for retirement decades away and use a brokerage account for near-term milestones where you need penalty-free access to your cash. You can also optimize your taxes by prioritizing Roth accounts when you are in a lower tax bracket in your 20s and shifting to traditional accounts when you hit your peak earning years in your 50s. Gurus will try to sell you complex trading algorithms and high-effort strategies, but decades of historical data prove that passive, consistent investing wins. The absolute optimal strategy for building wealth is incredibly boring. You automate your contributions into low-cost index funds, wrap them in tax-sheltered accounts, and let time do the